Good afternoon, everyone, and thank you for joining us for the first session of Cherry Bekaert's 2024 Not-for-Profit Speaker Series. My name is Amy Dosick, and I'm a Tax Managing Director and the leader of Cherry Bekaert's Not-for-Profit Tax Group. This series is intended to provide not-for-profit leaders with the tools necessary to embrace a mindset of continuous innovation and achieve increased organizational agility. This year, we're offering sessions on different days and times in hopes to meet you where you are and provide quality, industry-specific CPE, all free of charge. We hope you're planning to join more sessions throughout the next several months for this speaker series. I'm pleased to be joined today by speakers from our Tax Credits and Incentives Advisory Group. They include Marty Karaman, who's the Cherry Bekaert's Tax Credits and Incentives Advisory Leader, Timothy Doran, a Director in our Tax Credits practice, Andre Cohn, a Senior Associate in the practice, and David Moimani, a Manager in the practice.
All right, Amy.
We're going to start off.
All right, go ahead.
We're going to start off today by talking about a few macro trends that are going on in the not-for-profit and governmental sector. Actually, we're going to start off with our agenda. So we'll start off with a macro overview of kind of the macro trends going on in the tax-exempt and government sector, and then I'll turn it over to our subject matter expert team to give you an overview of the Inflation Reduction Act credits. We'll then go on to a high-level summary of direct pay and the 179D allocation opportunities for not-for-profits and government entities. We'll dive a little deeper on the investment tax credit and the production tax credit, and also talk about the process of direct pay, of how you claim the credits. We'll finish up with some information about Section 179D and that expanded opportunity around real estate and construction projects. And we'll end up with a real-life example of how to scope and quantify your credits. So I think we're going to start today with a polling question.
All right.
And so our first polling question is, have you investigated any Inflation Reduction Act opportunities for your organization?
Okay. And this is Marty Karaman, by the way. These tend to go about 30 seconds or so. I just want to welcome everybody today. I'm really looking forward to talking to you with my team, including Tim, Andre, and David. I think we have a lot to say. We've been actively evolving our organization to work more with not-for-profits post-Inflation Reduction Act. There's been a lot of developments with respect to both our process and the law. So, Amy, thank you for hosting us, and our team's really excited to talk to everybody today.
I couldn't agree more. All right, so I think our poll has closed, and you see the results there up on the screen. And so it looks like about 3/4 of our respondents have not yet investigated any of the Inflation Reduction Act opportunities. We hope that as a result of today's session, that will change. Okay, so as we move forward, as one of our industry leaders for tax-exempt and government entities, I thought I'd start today by just talking about some of the macro trends we're seeing among some of our clients in the sector. And as you look at these bullets up on the page, they could really be the trends for many sectors in the for-profit world as well. And so as you know, many of our clients are looking to do more with less, and the needs for their services increasing, we see the need for revenue diversification. And so the opportunities we're going to talk about today are a way that you can stretch your budgets and afford some things that maybe you thought you didn't. We also see changes in the philanthropic landscape. We see generational changes as the workforce has changed and more millennials and Gen Z workers are making up a larger percentage of the landscape, as well as the generational wealth that is shifting as baby boomers retire and older generations pass down wealth to new generations. We also see inflationary pressure on capital and annual budgets. Increased sustained high interest rates are putting a damper on the ability of our clients to borrow, as well as increasing expenses across the board for everything from labor to construction projects. And so again, the opportunities we're going to talk about today are a way to relieve some of that pressure on especially capital budgets. We continue to see a lack of skilled workers, and particularly in the accounting and finance function. We have many clients who've had significant turnover. And so when you think about the ability of teams to do the work around these credits, we're grateful to have Marty and his team who can really be supplements to your organization in making the most of identifying and quantifying these credits. We also see the influence of AI and machine learning on everything from chatbots that may talk with donors who are making a donation to your organization, to the ability to automate repetitive administrative and other tasks. For those of our clients who are in the not-for-profit sector, one of the trends we see in giving is donors, particularly institutional donors, who are really asking our nonprofit clients to measure impact and return on investment in a new way. And so being able to capture some of the credits we'll talk about today is a great way to demonstrate to funders, particularly institutional funders, that you're being good stewards of assets and making good use of donor funds. And lastly, there's sustainability. Many stakeholders, from students at colleges and universities to funders, are looking at green building and other sustainability efforts as something that's a requirement for continued funding. And so this is a great way to demonstrate that to funders and other stakeholders as well. And so these are just some of the trends that impact what we're going to talk about today in a positive way. And so without further ado, I'm going to turn it over to Marty Karaman and his team to dive in. Take it away, Marty.
Very good. Thank you so much. Okay, so I will begin this, and I get some of the easier stuff here because I think Tim and David are going to talk to everyone about some of the nuances and specifics around direct pay, where Andre is going to talk quite a bit about 179D deductions and how they're allocated back to a designer and the value that can be gained from that process. But just to level set, the Inflation Reduction Act, as many of us know, was passed back in 22, and it kicked in into relevance and being enacted in 2023. Its focus, really, one of its focuses is on providing incentives for renewable and sustainable energy. There had always been a number of incentives out there, but they're so much more powerful now due to what we're talking about today. Specifically, one of the reasons so powerful is direct pay. Now it's available to not-for-profits and state governments and other municipalities in the form of not a tax credit that would go on a normal taxpayer's return, but rather an actual check that comes back from the government. So if we're focused on the implementation and investment in things like solar, wind, and geothermal, combined heat and power systems, carbon capture, clean hydrogen, things that would be invested into by a not-for-profit or a state government, to get a check back from the government, that clearly incentivizes that kind of behavior much more than having to get into some kind of partnership with a third party that may be able to take advantage of the credit, as you had to do in the past. So direct pay and the ability to allocate some of these incentives under the deduction for 179D is the game changer that we're going to talk about today. But just some other things that have happened too is that the Inflation Reduction Act allowed some of these credits to be transferable, meaning sold. And so it's created a new marketplace to buy and sell federal tax credits for taxpayers. It reinstated some manufacturing credits beyond pure energy credits in the form of a Section 48C, which is available to some taxpayers out there, and also additional credits for the production of clean energy components. So a lot of it is focused on energy generating type property, but some of it's really in the manufacturing space too. But we're going to go through every credit that is available for direct pay, and we're going to talk quite a bit about the 179D deduction for investments into the sustainability, essentially, of commercial buildings. One other thing that the Inflation Reduction Act did was create credit boosters. You have a baseline credit, but then beyond that, to the extent you have and pay the workers a prevailing wage, and if there's an apprenticeship program, the credits are boosted up in amount. There's also specific boosters for domestic content utilized in the technologies implemented too. So we'll talk about that a bit as well. So again, focus here is on rolling out these incentives to more than just those that would have a credit that goes on the tax return, and with a focus as well on increasing the payment to the workforce and encouraging the utilization of domestic content in the U.S. Some of the same stuff here, but we're really, IRA's focus is to cut carbon emissions by 40% by 2033, I think. But again, prior to the IRA enactment, renewable energy credits were really promoted through non-refundable tax credits. There were a few different types of tax equity investment structures that our clients would get into in order to sell essentially some of these credits, but it was really complex. And so again, today, when we're talking about direct pay, it's a pure simplification of the ability to take advantage of these sustainable incentives. All right. I think at this point, I'm going to kick it over to Tim Doran a bit to talk a little bit more from an intro standpoint if he wants to cover anything else here. But then we're going to get into some of the nuances of the direct pay regime.
Great. Thank you, Marty. As Marty said, my name is Tim Doran. And as Amy introduced me, I'm a director in Cherry Bekaert's tax credits and incentives and advisory practice. I help lead our energy credit work. I come to Cherry Bekaert by way of in-house counsel at a large utility and worked in a lot of renewable energy development before the Inflation Reduction Act. So I'm excited to talk maybe just very briefly as we go through some of these slides about kind of the history and where all of this came from, and add a little bit of flavor to kind of what Marty introduced. So we've got two opportunities to discuss today, and Marty talked briefly about these two. And the first one, we're going to dig in a second here to a couple of the kind of bread and butter credits and how they work, and how much money they offer based on a percentage value of your investment, and then how they generate that direct pay at the tax exempt level, especially the investment tax credit and the production tax credit, which are those Section 45 and Section 48 that you see there on the slide. And then I'm going to turn it over to Andre after David and I have a chance to talk that through, and he's going to talk about how we can allocate deductions in certain circumstances under 179D and the new opportunities that came out of the Inflation Reduction Act there. Real quick, maybe to take just a high level step back to go through these. These apply differently to tax exempts, and we're going to talk about how that works because they're a direct payment to the extent that you can generate these credits. But when you hear these words, deductions and credits, for those who don't play in the federal tax space, a lot of times, the way a credit typically works for a for-profit taxpayer is you apply that credit against your tax liability owed. And so most of you probably know this from your own personal income tax returns, but you have an income and then you multiply a tax percentage against that income. And to the extent that you have an amount you owe to the IRS, you might also have credits that you've earned through various activities and behaviors, and you apply those credits to the amount that you owe. Where a deduction, as we'll talk about in 179D, is actually a reduction of your income tax. So to figure out really the effect of that deduction, we multiply that by your effective tax rate to kind of figure out what the benefit is there. So there's two different concepts that we'll be walking through today that function a little bit differently, and we'll go through all of those. 1 second. All right, the investment tax credit and the production tax credit. I think this first one is probably going to be the one that we've already seen be the most applicable in the tax exempt space and will continue to be. We're going to walk through how both the investment tax credit and the production tax credit work, but just know this first one we're going through is likely the one that's going to be the most powerful for most folks. This existed in a little bit different form before the Inflation Reduction Act, and the folks taking advantage of this were largely big institutions, utilities like where I used in the space that I used to work in, large developers where they were placing solar and wind farms into service across the country and helping to deal with some of the costs of those investments through this federal tax credit. And Congress took that old regime and in their refresh in the Inflation Reduction Act really democratized it, made it available to a lot more people, and then as Marty had already mentioned, juiced it up and made it a lot more powerful in terms of how many dollars you actually get back based on your investment. So this is a credit which is calculated off the dollars that you spend or invest into eligible property as defined by the code and underlying regs. There's a base credit amount, which was 6% of the basis. And what we mean by basis is generally the cost of that qualified energy property. And qualified energy property, as you'll see, we have some lists of the different technologies that qualify are pretty voluminous. But that starting point is the 6% of your costs. Now, if you meet prevailing wage and apprenticeship requirements when applicable, and in some cases you're accepted from that requirement, the true base credit actually goes up to 30% of your costs. And then we have additional bonus credits. So the bonus credits are added on for meeting particular criteria. One of them, as you can see, is domestically sourced. So there are a list of rules for whether or not what you're purchasing can be considered domestically sourced. They include whether or not your steel comes from the United States of America and a certain percentage of the cost of your other components come from there. That gives you an extra 10% layered on. It's additive. So supposing you met the domestically sourced materials requirement, you would go from a 30% credit to a 40% credit. And then there are other additional credits based on the geography of your project. So if your project is being placed into service in certain energy communities or other areas as defined by the code, you can get another 10%. And that's where we typically tell folks that if you're meeting these various requirements, prevailing wages, domestically sourced geography, you can get up to 50% back on the money that you spend on this qualified energy property. And that becomes even more powerful in the tax exempt world, because we're talking about, and we'll go through how it all works in the process for applying for this, but we're talking about a check back from the US Treasury for potentially half of what you spend. It's applied in the tax year in which you place the property into service. There are some limitations for for-profit taxpayers, and we list out some technologies. We can go ahead, Marty, because we'll get into those technologies a little bit more in some later slides. The production tax credit is a little bit different in that it is actually calculated off of how much electricity or energy you produce off of some of these different pieces of property that we're talking about, and then ultimately sell to another party. And so in this context, this can still provide a direct pay. There's some analysis that can be done as to whether or not it makes sense to go after the investment tax credit or production tax credit, because you can only take one or the other. But this is another way to monetize and generate these credits from the placing in service of this type of property. The other thing I'll briefly mention is that there are subcategories, as Marty pointed out, in the manufacturing space that also fall under this kind of production concept, where you're making a widget and you're selling it, and then based on the volume of that, you're getting a credit back that you calculate. So here's a list of some of these technologies. There are subcategories to these technologies, that are probably a little bit outside of the scope that we can get into, but there are a host of different things that you can be putting into service as a tax exempt entity that are going to generate these credits. We see a lot of solar panels, whether they're standalone solar out in a field, or they're solar panels on roofs, or maybe they're even unique kind of solar applications where you have picnic tables in a park with solar on top, or maybe electric vehicle chargers that also include a solar roof over top of the chargers. There's a lot of different ways in which solar is used, but that's kind of one of the first things we see when we talk to people. There's wind. We do see a lot more geothermal generation that's eligible. You see the landfill gas on there. There's a lot of different renewable natural gas type options. Hydropower, municipal solid waste. One of the things that I think is really important to point out on this is prior to the Inflation Reduction Act, energy storage could only qualify in very limited circumstances, but batteries and thermal energy storage are becoming a really popular option in terms of figuring out ways to arbitrage your energy costs and be more cost efficient, energy efficient, and those now separately qualify for these credits. Geothermal heat pumps, EV chargers. One of the things that I don't see on here, which is its own credit, that's not an investment tax credit, is hybrid and electric vehicles can also qualify for these credits. Which brings us to our next polling question. Is your organization considering any investments in clean energy? And while we have that up, I'll say that our experience so far, and this stuff is very new, right? So this started with things placed into service in the tax year in 2023. When I say this, I mean direct pay and most of the Inflation Reduction Act benefits. So we're still working with brand new concepts and getting rulings and guidance from the IRS and Treasury. But what's interesting is we're seeing some folks who, we're tracking the IRA and we're interested in using it to generate, but we're seeing a lot of folks, and I think this goes back to our first polling question, who were already going sustainable. They were going green. Their organization wanted to tackle, maybe climate endeavors or interested stakeholders wanted to see them become more energy efficient. And now they're just learning that there's opportunity to get a lot of potential money back and a check from the U.S. Treasury, and that's really powerful in terms of planning budgets and going forward. So I will turn it over to David Mohamani to take over the next section.
Tim. Okay, we are going to get into the IRA credit and deduction enhancers. My name is David Mohamani, by the way. I'm a manager in our group. I have about 8 years experience in the renewable energy tax credit space. And I just wanted to thank you guys for taking the time to be with us today. I know it's a very busy time for most, so appreciate it. So Tim had mentioned the concept of credit rate increases. There are these available now that were implemented by the IRA. Prevailing wage and apprenticeship is the largest component. As you can see, it's 5 times the base credit. So if we're talking about a solar panel, it goes from a 6% credit for installing that solar to a 30% if prevailing wage and apprenticeship requirements are met. And we'll go into more detail in the next slide about what prevailing wage and apprenticeship requirements are. But that is a very large aspect of considering whether this investment makes sense. Not all projects are subject to prevailing wage and apprenticeship based on the size of the facility or the asset being placed into service. But we'll talk about that a little bit more. There is an additional 10% bonus for domestic content requirements. So for domestic content to be met, so 100% of the steel and iron has to be US based or US sourced. And then 40% of the remaining components must be domestically manufactured for projects beginning prior to 2025. After 2025, there's an increase of 5%. So for each year until 2027. So by 2027, you will need 55% of the materials outside the iron and steel to be domestically sourced to qualify for that specific requirement and bonus. There is an additional 10% placed in service for an energy community. So the Department of Energy has a mapping tool that you can utilize where you simply just type in the address of where your asset is located, and it will tell you if it is located in a qualified energy community. There are 2 additional bonuses which are less common, but there is a 10% adder for solar and wind facilities with a maximum net output of less than 5 megawatts if it's in a low income community. And then there's a 20% bonus if the project is part of a qualified low income residential building or qualified low economic benefit project. Those fact patterns are not nearly as common as potentially domestic content and energy community, but based in the not-for-profit world, it may be something that's more prevalent than in, let's say, normal taxpayers. Okay, so let's get into prevailing wage and apprenticeship requirements. So what we mean by prevailing wage is that any laborers or mechanics must be paid a prevailing wage, and that is determined on the location of the project and the type of work being done. So you will go to the Department of Labor, they list out the types of work, like what they're labeled as and what the wage rate is for that specific location. So it varies quite a lot depending on where you place this asset into service. And you must be paying the employees that work on the construction of this that prevailing wage rate. Now, one thing that comes up a lot is people say, well, we're just paying the contractor, we don't know what they're paying, so is the onus still on us? It is, because you are the beneficiary of the credit. So it's important to make sure that you have discussions with your contractors on, what wages will be paid and seeing if that will meet prevailing wage. Now, let's say you were unaware that this was something that needed to be satisfied to reach the credit amount, and you already started a project and you have not been paying prevailing wage, or your contractor has not been paying prevailing wage. Not all is lost. You're allowed to make what they call cure provisions, where you can essentially make up the difference between what was paid to the employees originally versus what they need to be paid to satisfy prevailing wage and requirements. Apprenticeship requirements. So for any project after January 1st, 2024, 15% of the total hours must be completed by a qualified apprenticeship program. There is a good faith effort exception. So you have to at least prove that you made an effort to hire qualified apprentices to be able to, maximize that prevailing wage and apprenticeship requirement and increase your base credit 5 times. And this is true for both ITC and PTC, as well as the 179D deduction. Okay, and now we are going to get into direct pay. So the IRA introduced this concept of direct pay under Section 6417, which will allow organizations to monetize these clean energy investments. These organizations are ones such as state, local, tribal, not-for-profit, U.S. territories, and then other entities. So we finally got this registration tool online late 2023, I believe, like late December. It finally became active. So individuals who plan on utilizing this program can now register their credits online. And we'll kind of go into more of the registration process as we continue throughout the show. But this portal is now up and running. Okay, and about a month and a little over a month ago, I guess you could say, we got the final rules released on direct payment. They kind of just clarified what is included in these tax exempt entities and who is eligible for direct pay. The number one takeaway from that was that it was clarified that public universities and public school districts are now eligible to monetize their tax credits through direct pay. So that was really the big piece that we got from the final legislation that came out on March 5th. Okay, so now we're going to go into the registration process. So let's say you've made this investment in solar, let's say, because it's easy to discuss, and you want to claim direct pay. So you are going to have to complete the pre-filing registration. And what we mean by this is there's ID.me account, and you will log in and you will, answer certain questions about, the taxpayer, and who has authorization by a taxpayer to create an account to register for this direct pay. The users will provide personal information and the name and address and employer identification number of the taxpayer. You must make attestations that this is accurate. So you have to declare that you're saying, the information provided is true and complete to the best of your knowledge. and that you are a corporate office partner, guardian, executor, receiver, administrator, or trustee, or individual that has the authority to make this authorization on behalf of the taxpayer. And once the pre-filing registration comes to pass, you will get a registration number, and this registration number is unique for every single person claiming that direct pay. And now if changes must be made, you're going to have to wait until it has been your registration number has been returned, or you receive comments that explain why it was not registered. So there's an issue with the registration. Okay, this kind of breaks it down simply at how it works. So like we discussed, you make this investment in a clean energy technology. You will notify the IRS while working through that pre-filing registration portal that you are claiming to take direct pay, and then you will file your 990T. That's typically the form that will be used in the not-for-profit space. And then you will just get a check back for whatever applicable percentage of that investment you are eligible to receive, and you'll just get a check in the mail. Okay, so let's kind of go over the timeline. So there's been some guidance that's come out. We're still kind of waiting to see if this timeline, exactly how it falls and how it gets refined as this process matures. But the pre-registration filing should be done no earlier than the beginning of the tax period in which you earn the credit, or no earlier than after placing an investment property or production facility into service. And then once the pre-registration is complete, you will obtain that number, registration number, which you will use to put on your 990T to receive that direct payment. It can take up to 120 days. So they are saying that entities who are claiming or planning on claiming for direct pay, they should complete that pre-filing registration at least 120 days prior to when they plan on filing their 990T. That timeline could be refined as this process matures, as mentioned, but just wanted to point that out. And then when you would file this, so if you place a project in service in 2023, you would begin this process in 2024. And then once you receive the registration number, you can file your appropriate 990T form for the tax year in which the asset was placed into service. Okay, so as mentioned, you will have to file the form 990T. In most instances, you will also need to file form 3800, which is the general business credit. For most tax-exempt entities, the deadline to file will be the 15th day of the 5th month at the end of an entity's tax year. So if your tax year is a calendar year, that would be May 15th for most people. And then one nice thing is that entities without an annual filing requirement will receive an automatic paperless 6 months extension to file the return and make a direct pay election. Now, I think I'm going to pass it back to Tim here. Thank you for your time.
Thank you, David. That was great. Yeah, one other thing I'll mention real quick before we get onto this slide is there are several forms that need to be filed that David went through, and it's likely, especially for folks that aren't typically filing federal tax forms, recommended to get somebody who is an expert in that area and knows what they're doing. There are other source forms that we didn't list out on there based on the type of credit that you might be claiming that also get attached, as well as some certification statements that may apply as well. So there's a little bit that goes into it, and that kind of is a great segue into what we have up on the screen here, which is qualifying cost examples. And this is a lot of the work that my team actually does, and where this gets a little bit technical. Is there are a lot of regulations, rules, and carryover law from before the Inflation Reduction Act came out on how to identify what the actual qualifying property and associated costs are with respect to these different technologies and these different credits, right? And so there are different ways to go about looking through and documenting this. But as we'll see on the next slide, it is an important part of going to claim these credits. But you'll see based on the type of technology, there are different things that qualify, right? So your basic solar panels are obviously going to be qualifying technology because you need those. They're functionally interdependent in order to generate solar electricity. There's going to be necessary wiring. There might be racking and structural changes. There's an inverter to change that DC power that your solar panels are generating into usable AC power. But there are some costs that are ineligible, right? If you decide that we're going to put solar panels on the roof, and because of that, we're going to replace our shingles, or we're going to do some changes to the roof. To the extent that it's unnecessary to put those solar panels on your roof, those are likely ineligible costs. And you wouldn't be able to include the cost of that in your calculation of what your 30% multiplied by your qualified eligible costs are. So for each of these technologies, as you can see on the screen, there are different things that we need to weigh and look at and say, these are qualified, these aren't. And then there are considerations within there to applying all of those different rules that we talked about in terms of how do I look at my bonus credits? Where do prevailing wages apply? What is maybe my developer or contractor doing, and how do I parse through all of that? The list of costs that you see here are not exhaustive, but just to give you an idea of kind of the analysis that often takes place, especially with larger projects and larger credit amounts.
And real fast, Tim, I just want to add, there's a lot here. And I would say, like, with great power comes great responsibility for a lot of these organizations out here. There's a lot of compliance and interesting nuance with respect to what costs do and do not qualify. One of the points of this thing is to sort of marry up the pragmatic with the technical so that no one worries about this being too difficult. We are here, and other consultants are out there as well, just to talk through what you're doing from a project perspective. It's that simple. Just to understand where your investments are. And then from there, we can decide which ones maybe make sense to pursue for direct pay, or which, may not be in that. And then beyond that, we'll ask for some data to help scope it out. So there's a lot here, but it's nothing to be afraid of. There's just so much opportunity. I'll keep doing. Sorry.
We'll go quick with these last two slides because I want to give some time to Andre, but I do believe this deck will be available after. So if you want to go through and look at some of these additional considerations, but I'll point out a couple. One of the interesting things, in addition to what David had mentioned about those final regs that we got, was that there's not a chaining of credits. So for any of you that are following this stuff, there's another opportunity out there where you can buy and sell credits that fall within this space. What you can't do, because this was a question that came out almost initially after the legislation was passed, was, hey, can I go out and purchase credits at a cheaper price and then claim direct pay at the full price on them and recognize that differential? And the answer is no. The IRS has made that clear. There are other rules around, and this probably applies to a lot of tax exempt folks. To the extent that you're having grants or forgivable loans, that does not exclude you in most cases from taking a credit. However, there is a limitation, and one of those limitations is that in general, your credit plus any grants or forgivable loans or other similar aid that you receive can't exceed the total cost of what you're doing, which I think is a pretty reasonable limitation. In addition, and this goes back to what Marty and I said on the last slide and throughout this kind of presentation, if you claim an excess payment beyond what you are actually eligible to claim, the IRS, suppose they come in and audit and they find that you actually claim more than you were due. Not only do you owe that amount back to the IRS, but they will claim an additional amount of 20% multiplied by that amount in terms of payback. And so this is where we're saying, I think for any folks going after these credits, and especially in large amounts, to talk with your consultant. We're happy to chat with you too, to figure out how to properly and efficiently document and substantiate what you're claiming. This is a quick scenario that I'll walk through too, right? So we kind of already did this, and David kind of walked through how this works, but suppose a tax exempt, a county, a not-for-profit is considering investing $1 million in solar panels. They want to get the maximum benefit. They look in and they make sure the technology that they're claiming qualifies. They are looking to make sure that if they're subject to prevailing wage and apprenticeship requirements, the developer meets those, the subcontractors meet those, they document that they were met. They go out and they complete the pre-registration in anticipation of filing. And then they determine that they're eligible for a credit of 30%. They file their Form 990-T within the time frame in which they are eligible to file. And ultimately, within 45 days, the IRS has promised that that the entity will receive a refund check of $300,000 based on that $1 million investment. And I think that brings us to polling question number 3. Are you interested in learning more about how your organization can utilize direct pay? So I mentioned at the outset of my discussion portion that there was this credit concept, and the credit concept is what creates the direct payment, but there's also this idea of deductions. And, that's a little like, how are deductions going to apply to someone who's tax exempt and doesn't pay taxes? And I don't think about what my taxable income is. Well, I'm going to turn it over to Andre in a second once everybody has had a chance to answer this poll, and he's going to walk you through exactly how all of that works within the structure of the 179D deduction.
All right. I think we just move on.
Okay, so I just wanted to make sure we had a chance to close out the poll. So thank you everyone for joining us again today. My name is Andre Khan. I'm a senior on our tax credit and incentives committee, and I definitely hope that you are learning something today. We've seen a few folks ask if we're going to be able to provide you with some slides after the call, and you will receive a link with the entire presentation. So let's talk about direct pay and how it varies pretty significantly from 179D and the deduction and how it's allocated. So direct pay is a great way for tax-exempt entities to receive a refund from the service for all of your clean energy investments. But for Section 179D, it's a little different in that you have to work with the designer to potentially benefit. And the designer is referred to by the tax code as anyone who creates technical specifications for the installation of energy efficient commercial building property, and then goes on to specifically enumerate architects, engineers, and contractors. So on the next slide here, let's talk about Section 179D, what it is, how much the deduction is worth, what's required to calculate, certify, and claim the deduction, and then we'll talk about some of the updates to the Inflation Reduction Act and how it completely revolutionized this incentive. So Section 179D is known as the Energy Efficient Commercial Building Tax Deduction. It was enacted by the Energy Policy Act of 2005 in what you'll hear me refer to as old law. And it was written into law as a one-time incentive for commercial building owners and designers who design and construct energy efficient commercial buildings. So there's 3 main building elements we're going to take into consideration for renovation and new construction projects. And those are the HVAC, the interior lighting, and the building envelope. Now I want to talk about how the old law sort of impacted the deduction so that you can see how much has changed via the Inflation Reduction Act. And originally, the deduction was worth up to $1.88 per square foot and was recently increased to a little over $5 per square foot max following the Inflation Reduction Act. So this is how we calculate the deduction. So taking the plans and specifications of the building, we run an energy modeling analysis using a Department of Energy approved software for 365 hypothetical days. And then we compare it to an ASHRAE baseline standard from 2007. So a pretty older standard. Now, under old law, if your building had a 50% or higher annual energy cost savings over that ASHRAE standard, then it was eligible for the maximum of $1.88 per square foot. Now, the energy modeling analysis had to be certified or has to be certified by a third-party professional engineer. So they must physically go out and perform a field inspection or certification of the plans and specifications installed per our energy modeling analysis. And that professional engineer has to be registered in the state where the building is located. Now, there's 2 ways to claim the deduction. So commercial building owners claim the deduction themselves by decreasing the basis of their building by the amount of the deduction. But for designers, specifically folks that you'll be working with, they have to get a written form of allocation. So I like to call it a permission slip. So we have professional engineers going on field trips, and then you need a permission slip from the entity who's allocating to you. So before, under old law, that could only be government entities. All right. So In review, we have a one-time deduction worth up to $1.88 per square foot of the building. Commercial building owners and designers take advantage of it. That requires an energy modeling analysis, a certification by a third-party professional engineer, and an allocation letter. Now, let's talk about on the next slide how the Inflation Reduction Act has really supercharged Section 179D and some of the other updates.
And hey, Andre,
So-
just to interrupt for a second, I just want to
Yep.
level set with everybody who's listening. If you have a commercial building and you're making an upgrade to your interior lighting, to your HVAC, to your windows, to your roof, to your insulation, you most likely are going to exceed the energy efficiency thresholds that are established in order to qualify for what would be a deduction if you were a taxpayer. Instead, you have a thing of value that you can actually give back to this designer with whom you're working in exchange for something. And that's the benefit to you, is you have something that they want and they'll give you something for it, most likely. And so that becomes a discussion that you'll have with them, but you have a thing of value which the Inflation Reduction Act created for you. And so I just want to be clear. It's as simple as making those investments in HVAC, your roofing, your interior lighting. Suddenly, boom, you have something there to work with. All right, we'll keep it. I'll be quiet.
Thanks, Marty. And Marty's absolutely right. And I think one of the biggest spikes in interest for this is not only nonprofit organizations being able to allocate, which we'll talk about, but it's also the significant increase in the deduction. So let's take, for example, 100,000 square foot office building that meets all requirements of Section 179D and achieves a maximum deduction. So in 2022, that would have yielded $188,000 in deductions. Now, in 2023, when adhering to all the Inflation Reduction Act requirements and energy modeling requirements, it could have yielded $536,000 in deductions. So a pretty sizable increase there. There's also a reduction in energy savings. So let's say your building is efficient, but maybe it's not quite the 50% energy savings requirement. There's now a sliding scale that starts at 50 cents per square foot, and it goes up to $1 if your building energy, if your annual energy cost is over 25% of the ASHRAE standard. Now, in order for you to achieve the bonus deduction of up to $5.65 per square foot, you must meet the 50% energy savings and adhere to the prevailing wages and apprenticeship hour requirements that David mentioned before. Now, here's definitely one of the most important parts of the day. Like Marty said, nonprofit organizations, religious institutions, private schools, and other tax-exempt entities that work with architects, engineers, and contractors can now allocate to these designers. Now, there's two reasons you should do it. Reason number one is it's really good for the ecosystem of construction. This allows them to invest back into their business, allows them to continue to hire and retain talent, and make the building process more efficient. But it also affords you an opportunity to potentially benefit from it. Now, while you're a tax-exempt entity and there's no formal mechanism for you to benefit from a tax deduction, what we have seen are upfront negotiations and a reduction of construction costs. We've seen extended warranty periods. We've seen supplemental donations back to the nonprofit programs, which is also attractive for designers because it's a tax deductible act. So lastly, there is a triennial reset. So before 179D can only be taken once, now every 3 to 4 years, as so long as there has been a renovation or addition to the building, then the 179D deduction can be taken again. So I think that brings us to our next polling question. Is your organization considering any building upgrades to HVAC, interior lighting, roofing, insulation, or windows? And once everyone's had a chance to answer the polling question here, Marty, I'll turn it back over to you.
Well, I think it'll be all of us. I think we're going to talk a little bit about some of the differences in the process going forward. But yep, very good.
Looks like we need to talk to about 37% of you all. I'm definitely looking forward to those conversations and your upcoming upgrades. So as we mentioned before, there are two sorts of options here in terms of direct pay. And as I mentioned for Section 179D, it's really going to apply more towards the interior lighting, HVAC, and building envelope that would not apply to direct pay, and that you would need to specifically work with a designer so that you can have someone to allocate that deduction to and potentially leverage it for some of the aforementioned benefits before. So that could be reduction of your construction costs, your extended warranty periods, or maybe even straight line donations back to your program. So Tim, if you wanted to speak maybe to some of the other options that they may have on the direct pay side.
Yeah, absolutely. We kind of went through a lot of these different potential investments earlier. I think we had maybe a couple here and that I had mentioned that weren't on the screen, such as the installation of EV charging stations, purchase of commercial vehicles. As I mentioned before, I think some of the big ones are going to be geothermal, solar, battery, and then those EV type stuff. Where that's at least what we've seen thus far in the tax exempt space as being some of the most applicable types of technologies. But if you see something on here, definitely worth investigating as to whether or not there's an opportunity to get direct pay. This is a list actually of all the credits. So if you rewind back to the kind of beginning of the presentation, where we were talking about section 45, which is the production tax credit, and section 48, which was the investment tax credit. Those are the ones that most typically apply, not just in the tax exempt space, but to a lot of the folks we talk to across industries. But there are a whole lot of other credits that were either modified or introduced by the Inflation Reduction Act that are also on here that are eligible for this elected payment. How we can help. So, this is definitely, a reference guide for you to look at and in terms of what we go through. But, I think the big thing is if you have something, that you think might be potentially qualifying, we here at Cherry Bekaert would love to chat with you, or if not us, talk to your consultant. But what we do is we will go in and we'll review all of your different projects, chat with you about what you have going on, and get, a high level understanding of what might apply, what might not apply. And most of our scoping, from our perspective, is free. We go in and we analyze what your spend looks like. And then once we get into it, it's all about doing the calculation and getting an accurate credit amount on the direct pay side, and then doing a good documentation of why you're eligible for that potential direct payment, and then ultimately filing for that credit.
Yeah, I think there's a lot that we can do here, both from an identification of the opportunity, but probably more importantly is the process beyond that in terms of either walking you through or helping you register and apply. And then also from Andre's perspective on 179D, helping discuss how you allocate that deduction back to the designer. Okay. This is really just some of the information that we're going to look for. And again, I think we're going to keep it somewhat simple, but we're really looking for project lists and understanding of what you're investing in, what the technology is. Sometimes we'll get a sense of what the address is, where it's being done. A lot of that goes to what the prevailing wage is in that particular location. Construction dates, beginning and ending, or plan beginning and ending. Your funding source, for example, are you getting some kind of additional federal funding that may go along with it? The energy capacity of the particular project, what materials are going in. A lot of that's going to be for the domestic content booster as well, and just what stage of the project you're in. We found that a number of a number of organizations are doing these kind of projects and didn't even know about some of these benefits here. And so the IRA hasn't been driving their behavior, but their behavior is rewardable through the IRA. So we're trying to catch them to make sure that they're doing the registration appropriately. For 179D, again, we want to get a sense of what those investments are, what the building looks like, its square footage, its location, its cost, etc. Again, all of that is something that we can have organized for you with some clean, understandable information requests and go through that with you and talk it through. All right. And then the rest of this here just talks about registering for the rest of the series. Amy, take it away.
All right. Thank you, Marty, Tim, Andre, David. I know I learned a lot. I hope you did too. If you've been with us for other series for our not-for-profits, you may know my colleague Matthew Saha often ends our sessions with a dad joke. Not being a dad, but being a tax person, I'll end today with a tax joke. And so the joke is, why did the IRS audit the chiropractor? Anyone? Anyone? Okay, since you're all muted, the answer is because he owed back taxes. And why am I not going to tell you any more tax jokes today? Because you wouldn't depreciate them. And so before I make you groan anymore, I will say that concludes the first session of our 2024 series. Thank you so much for joining us today. And if you have questions, please reach out to any of our panelists or to me at any time. And we look forward to following up with you after the sessions. We do value your feedback very much and depend on it to make sure these sessions are valuable to you. So please do take the short survey that you will get when you leave the session today and provide us with your feedback. Please also continue to check the registration site linked in the chat for upcoming sessions and the recordings of this session when it's available in about a week. Our next session will be Wednesday, May 1st at 1 p.m. Eastern, and the topic will be current expected credit loss and how not-for-profits will be affected. So thank you everyone for joining us today. This concludes our webinar. Have a great rest of the day.